Welcome to Realcast, the weekly roundup of the real asset markets. I'm joined this week by Nicole Dines, Dan Innes and Paul Strome. Nicole, let's start with you. What have you been tracking?
Well, pretty sobering news really for the real estate market in Europe. MSCI Real Assets produced their capital trends for Q1 of this year, and it shows that European commercial real estate investment slumped to an 11-year low in the first 3 months of this year due to, as we know, to uncertainty of valuations and higher financing costs. So the volume fell 62% across Europe to 36.5 billion euros. Most sectors were affected, particularly office sector and logistics as well. And MSCI said there was a real sort of change of fortunes for logistics, which, as you know, has been very much in demand in the last few years, especially after the pandemic. The UK remains Europe's largest commercial real estate market, but has had a 59% decline. France has overtaken Germany as the second, mostly because of some really large deals done in Paris in the first 3 months of the year. And Germany suffered quite badly. Volumes declined by 71%, the weakest level of activity since 2010. But as we were mentioning last week after our Germany briefing, our experts agreed that investment activity was basically at ground to a halt. But they seemed quite optimistic that things would happen, that things might turn around as economic circumstances change. And sure enough, there were signs of life in the German market as Vonovia, the biggest real estate company in the country, announced the sale of a 30% stake of its massive residential portfolio. So Apollo Global Management, the private equity group, has paid 1 billion euros to buy these 21,000 apartments and homes in Baden-Württemberg in southwestern Germany. There's a great hope that this big deal, 1 billion euros, could sort of revitalize the German market. I then looked at a couple of ESG-related news. As you know, I always try to follow. In the UK, three big beasts, Persimmon, Aviva and Goldman Sachs, provided together about £70 million of financing to Top Hat, which is a business that manufactures ultra-low carbon modular housing. And the money will go towards a new factory in Corby, and it will be Europe's largest modular housing factory. So that's, again, a positive development. And the logistic giant Panattoni has also announced that it's turning to brownfield size more and more for its development of new warehouses. They now account for about a third, but for example, in Germany, it's already 70% of new developments are on brownfield sites. They say that even though they cost more to develop, investors prefer them, partly obviously because of environmental credentials of reclaiming land rather than, but also because they tend to be near towns, close to in good locations, close to transport hubs, and they're very useful for last mile, which is always a very sought after locations. Finally, some good news for the UK. Again, much needed good news for the UK. Bayes Business School in London, which used to be called Cass Business School, has done some really interesting research that shows that lending to commercial real estate, despite the crisis, stayed really strong in the UK in 2022, and it looks like it's going to stay strong this year as well. So despite the rise in interest rates and the decline in market transaction, which we've seen in the UK as well, lending was £48.6 billion so the third highest since Brexit. And what's interesting is that there's a lot of alternative lenders coming into the market and providing financing when banks are reluctant to do so. And also, again, not a surprise, but there's a lot more. There's continuing strong financing for transitioning assets to make them ESG compliant.
Yeah, the transition side is going to be very strong going forward, I think. Dan, what have you been following?
Well, it's been an interesting week with events like World Retail Congress in Barcelona. There was Completely Retail Marketplace in London. And of course, you've got the Property Week Resi Awards coming up next week. But, as Nicole says, the mood music in European real estate has been a little bit doom and gloom. But noticing some positive stories. So, some people were commenting that the UK is set to lead a recovery in deal activity. Buyers saying that competition for deals is really heating up amid some sharper value declines and prices potentially having bottomed out in some sectors. That kind of makes sense. I suppose, the UK tends to reprice faster. So, hopefully we'll start seeing some more positive news coming in the next months. Elsewhere, in London last week, as revealed by CoStar, Unibail-Rodamco Westfield, or URW, they've finally taken back control of the redevelopment of that long-running project in Croydon in London, having taken back back Hammerson's 50% share in the Croydon partnership for an undisclosed sum. But the joint venture has seen a decade's worth of debate in the town centre over that project, whether £1.4 billion worth of development would ever really progress. The project includes the Whitgift and Central shopping centres, along with the high street retail frontage, office blocks, multi-storey car parks, right in the heart of the Greater London Authority opportunity area in south of London. Still in London, a lot of activity in the city. Shard developer, the seller, and Network Rail, they're expected to submit proposals to London city planners in the next couple of weeks for the £1.5 billion redevelopment of London's Liverpool Street station. Many people will travel into Liverpool Street to the city and obviously out to Stansted Airport. Herzog de Meuron architects, they unveiled plans last week, some rather nice images of what the station could be reinvented and given a new lease of life. And lastly, Nike, they're going to open a digitally focused store in Manchester to be called Nike Rise, a very specialist store for Nike. And interesting that they're going to Manchester first. It's going to be just around 13,500 square feet at Manchester's Arndale shopping centre. It's going to launch later this year. It'll be the first store in Manchester that will be the home for this new concept, and it'll take up the last remaining space for the former Topshop unit, which of course has seen a bit of vacancy around the UK. So that's good news there for asset managers M&G and Global Mutual.
Yeah, interesting to see that opening there in Manchester. Paul, what have you been tracking?
There's been a few stories in Warsaw's Wola office district, one of the main office districts in the city to the west. It continues to be a focus of activity, and both Lincoln and Adventum have just announced investments in the office sector there. Budapest headquartered Adventum Group has completed its fifth acquisition through the Adventum Penta Fund. The group has acquired the Wola Retro office complex. That was constructed in 2019 by Develia. It's a 25,900 square metre complex in two sections, and there's a low-rise conversion and a 19,000 square metre 14-storey tower behind it. Also, Lincoln Property Company has commenced construction of a 30,000 square metre office development known as the Form. Lincoln said that the development will set new benchmarks for sustainability and well-being in Poland. That development is scheduled for the completion at the end of 2024. Also, Heinz has been notably active in the area for a while, and in the last few months, it's got a 34,000 square metre Wola centre there, which they acquired in 2020, and that's just received a BREEAM in use excellent certification. So ESG's to the fore there. And in the UK, the social elements of ESG taking on more importance. L&G's suburban build-to-rent business has signed a 150 million 5-year revolving credit facility to finance a pipeline of 1,000 suburban build-to-rent homes. The facilities, interestingly, it's been provided by 3 UK banks, HSBC, Barclays and NatWest. L&G stated that as an institutional landlord, it aims to create family homes in areas connected to schools, transport, infrastructure and key amenities, and its homes are designed to reflect new ways of living post-COVID.
Yeah, and residential seems to be, one of the themes that is particularly still strong. Interesting, I noted from the US, there've been commentators for a little while talking about the doom and gloom there, particularly for the office. And some may have seen Patrick Carroll, CEO of real estate investing firm Carroll, saying essentially that areas like office and hotels would be destroyed, was the term he was using, and saying it's going to be ugly, it's going to be at least as bad as 2008 and 2009. And interestingly, I noted Vornado, so Vornado Realty Trust, which is one of the largest publicly traded REITs in the country and one of New York's biggest office landlords, has announced that it's not going to pay its share dividend for the rest of 2023. So that suggests as well that some of the comments that have been coming through are now actually beginning to be actively seen. So that one will be interesting to track. Thank you, Paul. Thank you, Nicole. Thank you, Dan. Thank you for joining us, and look forward to seeing you next week for our regular roundup of the real asset markets.